All right, hey everybody, we'll go ahead and get started with this webinar. So again, I'm Delaney. Thanks for tuning in. I know it's August, so a lot of you could probably be on vacation right now or maybe on vacation. So this webinar is going to be about a ton of different ways in which your algorithm can look good, a model can look good. You know, the p-values can be great, the predictive powers can be good, but in the long run, it's just not going to be very good. And that oftentimes will come from violation of assumptions. You know, every model that you make has basically, you know, a whole host of assumptions that you make when you're when you are creating the model, and if those assumptions are not satisfied, then you know bad things can happen. I also wanted to say, if you guys have any questions throughout the webinar, please just go ahead and put them there. I'll be taking breaks periodically to answer the questions, and I'm also going to take some pauses between the notebooks. I'll warn you guys, but I'm going to put some pauses between the notebooks just so that we can edit around the pauses and produce a few different shorter videos rather than one long one. Okay, so I'm just going to go ahead and start. Again, we're working on a permanent home for all these lectures that you'll be able to like browse through and clone at your leisure. But in the meantime, you can find them on the forums at Quantopian lectures. If you search that, all the lectures that we have been tagged. Oh, Quantopian lecture, I apologize. See, this is why we really need a permanent home. And you can see the lectures here. The last three are the ones that we're going to be talking about today: violation of regression model assumptions, instability of regression coefficients, and this time you're more wrong, which talks about model misspecification. And then at the end of the webinar, we're going to go over this algorithm that David Edwards wrote, which uses Kalman filters to do pairs trading across multiple pairs. I think it's pretty cool. So we'll just go ahead and get started with this first notebook. This first notebook is talking about ways in which the assumptions that underlie regression models can be violated. And regression models are pretty widespread. So I'm not going to say overused, but they're used a lot. And that comes from factor models, because regression models estimate parameters for factor models. And factor models are just kind of ubiquitous in finance. They underlie a lot of the theory. And we're going to be doing a lecture, actually the next lecture that we do on August 26th, and the corresponding webinar will be all about factor models. And that's a really important topic, so I advise you to tune in for that. But yeah, so like if you have a regression model and you're estimating stuff, you're estimating coefficients, you're estimating beta, you're estimating parameters for a factor model, you're assuming a lot of things are true, and you might not know that. So what do I mean? So let's say you assume lack of bias in certain ways, you assume some consistency, you assume some normality, and the most important thing is you assume linearity, because a regression model is fundamentally a linear model. You know, so if the underlying data generating process is not linear, you're going to be in trouble. But a big point that I want to make that's going to be kind of, in my opinion, this is really, really important, is you want to focus on the residuals. And what does that mean? Well, whenever you have a model that's making predictions and you have some existing data, you can figure out what the difference is between the predictions and the existing data. You can say how, you know, what's the error? They're also known as, the residuals are also known as the errors. And then you can say, okay, the distribution of my residuals tells me an incredible amount about my model. And your model might be complex or difficult to evaluate. You might not be able to learn anything interesting from your model directly, but you can learn a ton from your residuals. So even if you have some big crazy model that's kind of black box, you can still look at the residuals to determine how well it's doing. And what you want to look for is basically, most of the time you want normally distributed residuals. Because if they're not normally distributed, then something weird is going on with your residuals and your model isn't picking everything up. Remember that a normal distribution is just the least information dense distribution. So if you have a a normal distribution of residuals, then it's basically saying there's no more information left in this. I can't get anything more out of my residuals. So testing for normality is really important, and as you'll see in this notebook, it'll actually catch a ton of cases. So basically, like, let's say you have residuals, and the first thing you should do is you should just test to see whether they're normal. And the test that I like for that is the Shark-Barra test. I'm not going to go into how it works, but for those of you who are familiar with skew and kurtosis, it just checks the skew and kurtosis of your residuals to make sure that they're within a reasonable range. And what you can see here is if I generate residuals from a normal distribution, the p-value is above 0.05, and if I generate p-values from a non-normal distribution, the p-value is below 0.05. And I'll say it again because it's important. This p-value is no lower than 0.04, right? 0.004 is no different from 0.04. If you say, oh, well, this p-value is way lower than 0.05, it must be really significant. No, that's not how it works. It's you open yourself up to bias by doing that, and what you need to do is you need to pick a cutoff. And if you want your cutoff to be 0.001, fine, but you have to pick that in advance. You can't start looking at the p-values afterwards and deciding what you want. So testing for normality of residuals is like a really good check, and that will cover you in a ton of situations, as you'll see a little later. The next one is heteroscedasticity, and heteroscedasticity, and this is when the variance of your residuals is not constant. So what does that mean? Well, here's a graphical example. Let's say that you have your blue dots are your observed data points, and you're doing a linear regression model through them. This is the trend line, and you can see is that these errors, the differences between your predictions and your actual, are pretty, nicely normally distributed, and they don't change based on the independent variable x. But in this example down here, they do change based on the independent variable x. So what this is saying is it's saying that the magnitude of your error is dependent on x, the independent variable. And that can lead to a whole host of problems with your model. Now, the interesting thing here is you can always test for this. And so this is also a really easy test. It takes one line, you run it on your residuals, and the test tells you whether or not you should worry. And so this is like, why chance it? This is one line of Python code. It'll be over in 2 milliseconds or whatever. Just run this line, save it, copy paste it wherever you need to, run this line, and this test will tell you, is there heteroscedasticity in my residuals? The interesting thing is that the normality test also catches this in this case, which is just further evidence that you should always be testing for normality, because normality will just be a really good smoke alarm. It's a warning sign. It just says, is something going on? It might just be that you've burnt toast, but it's at least worth a check. So the important thing in this case, though, is you have to be very careful, because you can have normally distributed residuals that are also heteroscedastic, I believe. So just doing a normality test may not always catch heteroscedasticity, and so you have to do both of them. It's just you can't rely on one or the other. And then, so let's say that you've determined that there is heteroscedasticity in your residuals. Well, the first thing you want to do is try to figure out what's wrong with your model that's producing this heteroscedasticity, because basically your model's not picking up on a huge amount of the behavior, right? So the behavior is that your model is more wrong the bigger that x is. So that's really bad, right? You want your model to be equivalently wrong no matter what x is. So the first thing you want to do is try to figure out how to adjust your model. The second thing you can do is, if you're just once you've accepted that you can't fix your model anymore, you can compute your model statistics, your summary statistics, and your standard errors in a way that it will correct for heteroscedasticity and basically give you standard errors that are more accurate. Basically, it'll widen the standard errors. It will say, okay, well, given that there's heteroscedasticity present, adjust my summary statistics so that I'm giving you more accurate summary statistics. My p-values are not going to be wrong in this case. Your p-values could be wrong with with heteroscedasticity. You could get a model that's significantly predictive, but is actually not because it's being masked by heteroscedasticity. Again, this is like kind of a last resort. The first thing you'd want to do is you'd want to adjust your model. So here's another example. This is serial correlation of errors. Some of you might know it as autocorrelation. So in autocorrelation, the value at time t in a series is dependent in some way on previous values. And this is like rampantly common in financial data for like many obvious reasons. You know, the price at time point t is dependent on the price at time t minus 1 plus some market movement, right? That's like kind of the definition of autocorrelation. People look at historical prices when they decide whether or not to buy something. So automatically you're incorporating information from the past into the future price, which means it's going to be autocorrelated. So many financial series are autocorrelated, and this is just something you should be testing for because it turns out that when something is autocorrelated, the normal summary statistics will be wrong. All these summary statistics have been developed by frequentist statisticians, and they basically assume that there's no autocorrelation. That's a big assumption that a lot of people don't realize when they're looking at like the p-value and the standard error and regression. That the both of those will be wrong if your underlying data is autocorrelated. So as an example, let's look at this pricing. This is the ticker DAL, and you can see here that like this is clearly an autocorrelated series. Why do I know that? Well, autocorrelated series tend to be spiky, okay? Why is that true? Well, if the price is high, then the next time point, the price is dependent on that previous time point, so it's also likely to be high. So you get these drives upwards and drives downwards, basically. You get these spikes. And autocorrelated series are way spikier than non-autocorrelated series, which means you have fat tails, which means that you're going to have a bad time if you assume they're not autocorrelated, because if you assume they're not autocorrelated, you're going to be like, oh, well, I know the most extreme event that could happen. And it turns out you don't know the most extreme event that could happen because the most extreme event that could happen in an autocorrelated series is way further away from the mean than the most extreme event in a non-autocorrelated series. And you can see here you've drawn this regression line through this price data. And this regression line is saying, okay, where's the price going to go? But it's really not a good model here because you have so much autocorrelation. You'd be better off using a model that corrects for autocorrelation, something more like an Archer-Garch model that stands for autoregressive conditionally heteroscedastic model, and we'll do a lecture on those in the future. But so you can see here is the thing is you can also test for autocorrelation, and you can test for autocorrelation both in the underlying data that you're trying to model, in this case prices, and in the residuals, in this case the prices minus your prediction for the prices, the red line just being your prediction here. And what you can see is that it can be a little tricky to tell because of the way this test works. But the way this test works, the statstools.acf test, is it implements what's called I'm actually not sure how to pronounce this, but a Jun-Box test. And what this does is it, for each of these lagged coefficients, it says the data point 1 time step ago, is it significantly predictive of the current time? 2 time steps ago, is it significantly predictive of the current time? And it looks for it looks for relationships between those lagged time points and the current time point, and gives you a p-value into whether or not that data point is significantly predictive. And you can see here these p-values are all very low, which means that there's an incredible amount of autocorrelation within both the prices and your prediction after the prices. And you want neither to be true. You want your residuals to not be autocorrelated. You want them just to be normally distributed. And of course, this is the easy normality test. We're going to do it in the residuals, and it catches the fact that there's something weird going on. Okay, so again, just test for normality. That's the first thing. And then also test for, I strongly recommend also testing for heteroscedasticity and autocorrelation. Those are just 2 really easy checks, and they can tell you when your underlying data is just not going to behave in a friendly fashion with your model. The Nui West test is a really good one. It's not a test. It's a correction method. Again, the first thing you want to do is you want to say, okay, how do I adjust my model to include the fact that the data is autocorrelated? But if you can't do that for whatever reason, then you want to use a correction method to make sure that you know how bad your statistics are. And Nui West will do that for you. I actually first learned about Nui West last semester. I was working with a prof at MIT Sloan, and he was teaching analytics of finance there. And the Arch and Garch lecture that we're going to do is going to be taken from the lecture that he does in his class. And I'm excited about that because he did a bunch of stuff on Nui West corrections earlier in the semester. So I got to see those there. But the long story short is that if you compute variance over an autocorrelated series, it's actually going to be wrong using a naive computation, and you need to correct that computation using Nui West. So that's what this does. And the variance is used to compute the standard error, so that's why you need a better estimate of the variance. So the next example here is multicollinearity. And what does that mean? Well, the long and short of this is that if your model includes two variables that are linearly, let's say in this case linearly, but like if your model includes two variables that are correlated, two independent variables that are correlated, well, those independent variables that are correlated are not going to be really explaining different parts of the variation in your dependent variable. So what do I mean by that? Well, let's say that you're trying to predict the price of HPQ using a model that's dependent on MDY and SPY. Now, MDY and SPY are very highly correlated. So what does that mean? It means that basically either one could explain the movement in HPQ just as well as the other one could. Okay, now this is a problem because what that means is you could have the model be a coefficient of 1 times SPY plus 0 times MDY, or it could be 0 times SPY plus 1 times MDY, and both would be just as good. So it's very poorly constrained. Your model will basically pick these coefficients at random. These coefficients will not be consistent. And the other weird thing is that normally, as you add more data points, you get a better sample size, you'll converge to a correct estimate. But in this case, you won't because there's no convergence. You'll just kind of keep jumping around between the two coefficients between these independent variables. So this is very dangerous. And the solution here is basically to try to make sure that your independent variables are not correlated, and to basically try to figure out if they are correlated, which one you want to include. Because my guess in this case is that SPY drives MDY, just because SPY drives pretty much everything. So you'd probably want to get rid of MDY and use SPY. And I'll show an example in the next notebook about how this would actually work and why this actually works. The general idea that you want to be thinking about is like, correlation, not causation. And so if you have two variables that are correlated, which one is actually the causal variable? Because that's the one that you want to use in your model. You can imagine if the SPY is driving MDY and HPQ, you don't want to be using MDY to predict HPQ because whatever relationship you find between them is going to be kind of spurious, and the real relationship is this triangle or upside down V. So here is the last example in this notebook, which is a famous one you might have seen before, which is called Anscombe's quartet. And this is just an example of how you can naively try to use a regression model to predict data and get exactly the same summary statistic, but be just like blatantly wrong 3 out of 4 times. So here, this is a well-defined model. You have like nice normal distribution of residuals. In this one, this is clearly a horrible model, right? This is a quadratic data process, and you're trying to model it linearly. But just because of how the data is set up, the average errors end up being the same. But remember, this R squared is just dependent on average errors. It's not telling you anything about the distribution of the errors, and that's why you need to test for normality, heteroscedasticity, and autocorrelation. Okay? In this case, normality would actually raise the alarm in these 3 situations. It would cover all of these situations. It would say there's something wrong, you can't use this model. So if you just test for normality of your errors, you'll catch yourself in these situations. So that's the first notebook. I'm going to go ahead and remind you guys, again, we're working on the permanent home for these guys, but in the meantime, remember that you can always get them on the forums. If you go to, again, search Quantopian lecture in the forums, you can get that one here. It's violation of regression model assumptions, and you can go ahead and clone the notebook, ask any questions you may have about it. I'll get back to you in the forums. Okay, so this notebook is on regression analysis again, and in this case, we're looking at ways in which maybe your assumptions haven't been as blatantly violated, but in this case, it's ways that other things can happen. I guess this is still violation of assumptions, but they're less like your whole model falls apart and more like weird things happen to your estimated coefficients. So here's a quick example. This is biased noise. Biased noise this really just gets back to small sample size. You should really try to have as big a sample size as possible all the time. But in this small sample size, you can see is that the noise has a downward bias. So the intercept has been estimated to be negative 0.4. So if you're running this and trying to determine the alpha and beta of an asset to another, you say, oh my goodness, my algorithm has a negative 0.4 alpha, which is horrible, right? You never use this. But as you can see, as you get more data points here, the intercept converges to 0. And basically, you were just looking at a small sample size bias, small sample size bias. Something else you can do, I think, that's cool is Seaborn has this nice regression plot, and you just put in your data points, and it draws the regression line, and then it takes the standard error, and it says, well, what's within my confidence interval, what is the most extreme slope in this direction it could be, and it draws that one. And then it says, within my confidence interval, what's the most extreme slope in this direction? It draws that one, and it fills this in. And so what you're seeing is you're seeing all the possible space, like basically the cloud of possible regression lines within the 95% confidence interval. And I think this is a nice way to look at your regression versus just more of a naive approach like this. So another big problem is regime changes, and that's when the data generating process changes. So an example might be, let's say that Britain decided to actually start using the euro next year. That would just completely shake up so many things, right? The foreign exchange markets would undergo a huge chaotic shift. Tons of stuff might be pegged to the pound. So where would it go now? This is an example of your underlying data generating process would change, and you just you're not going to be able to handle it, accept that, but you should try to test for it, right? You should try to test, are the conditions that my model is based on still present in the data, and then regularly test for these conditions. Every time your algorithm runs, just check, do a couple simple tests. Are certain tests still coming up as positive? Right? And these tests will be different for every algorithm, and you kind of have to think about your models and figure out what tests are necessary. As an example, so here's one where if you just draw the regression line through this data set, you get something that's useful, never going to be a good prediction. But these regression lines are actually pretty good predictions for this data set. The problem is that there's a regime change here, and then all of a sudden your regression line changes a ton. So what you have to do is basically at every point in time, look at the recent, maybe take a small Windows snapshot and say, is my last 30 days of regression line, it's a regression line to the last 30 days within that standard error of the regression line that I'm using for my model, right? And if it's not, you can see clearly here that let's say the standard error for this regression line is some cone coming out like this. You can see that this regression line would clearly be outside the standard error for your model. So you could say, as soon as you got to this point, stop for a second. We need to reevaluate whether or not our algorithm is still going to make money. So again, it's just smoke alarms that you can put in your models to make sure that you're not going to run into, make sure that your fires are going to be caught before they burn your money. Again, this is another example of multicollinearity. We just put it, we actually basically put very similar examples in all three of these notebooks just because we like the notebooks to stand by themselves. So I'm actually not going to go over this example. I'm going to go over a slightly different example in the next notebook. This is really the same example as the last notebook. So feel free to look over it yourself. but you've kind of already seen most of it. So model specification and misspecification. This is more generally than regression models. We're going to talk about some ways in which you can misspecify your model and then end up getting results that look significant when they're actually not, because just the assumptions that the model makes and the tests make are just not, or they're just violated. They're not satisfied. So one that's similar to the multicollinearity that we were just talking about is the exclusion of important variables. Now, what does this mean? Well, let's say you're trying to model the price of Apple or the returns of Apple using LRCX, which is a semiconductor manufacturer. Now, this might seem to be a pretty reasonable thing to do because they're in the same industry. You'd expect there to be a relationship between them. But as it turns out, if you look at the R-squared values of the relationships between these guys, LRCX and Apple is doing really well over this time period, 2013 to 2015. So you might look at this and be like, wow, R-squared of 0.91, I need that, right? But you got to be careful because you've excluded an important variable, and almost always your model should include this very important variable, which is the market, right? The broad market. What is it doing? How's your algorithm doing compared to the broad market? You know, how is this stock doing compared to the broad market? So you can see here that the relationship between LRCX and SPI is 0.87. That's like, we don't have a confidence interval around this. So it could, sorry, it could effectively be the same. We don't know. And then also Apple and SPI have 0.8. Again, we don't have a confidence interval around these numbers, so like they could effectively all be the same number. The point is they're all high. There's a strong relationship. So if you're making this model between LRCX and Apple, and then you realize, uh-oh, SPI also has a strong relationship between LRCX and Apple, then you probably want to step back and be like, all right, what's driving what again? Probably SPI is driving both LRCX and Apple, and so you want to include that in your model, right? And what you can see is if you move the time period to a much broader time period of 2009 to 2015 and do the same correlations, look at this, you can see that LRCX and Apple completely falls off that relationship, right? This relationship is not consistent. It was 0.91, now it's 0.5. There's a huge fall off, but this relationship between the market and LRCX and the market and Apple stays much more constant. Right? So this is saying that the model that uses the market to predict the returns of Apple and LRCX is a much more consistent model than the model that uses LRCX to predict Apple. Okay, so again, you've excluded an important variable, which is the market. And if you had done that and just looked at this first relationship, your relationship could very well have just fallen apart when you put your model out to trade. Inclusion of unnecessary variables. This is actually a similar example to the one that we did in the overfitting notebook, but I'm going to just go through it again because I think it's an important one, which is, let's say that you have a model and you're trying to predict the price of PG using these 4 ticker symbols, and you do a single linear regression between one that you hypothesize is in the same industry and therefore should have some relationship, and then a multiple linear regression using all of them. What you can see here is that the R-squared of the single linear regression is not bad, it's 0.71, and the R-squared of the multiple linear regression is 0.88 or 0.89, which is good. But you have to remember that this is over this specific time period, and so now you've overfit to this time period, because remember, the more complex your model is, the more you're going to overfit, and there's just no way around that. You're just going to start fitting noise to your data, and we can verify that by going to a different time period. We're going to go to the 6 months after that time period, and you can see that both models actually completely collapsed, right? Now, the important thing to note is that the multiple linear regression collapsed even more extremely than the single linear regression. So if you had been using the single linear regression, you would have lost money, but if you had been using the multiple linear regression, you would have lost all your money. So the important point here is that you want to keep your model simple, and you want to try to not include variables unless you're positive that they're going to be predictive. So if as soon as you start seeing yourself having like a 5 variable model, just be kind of worried, because it's like impossible not to start overfitting. Like the model will do its job, which is fitting, and it will overfit to noise in your data. And you just have to be really rigorous about testing out of sample to make sure that that model holds up. And as you can see here, both models do not. Errors in independent variables is an interesting one. So in this model looks completely innocuous, right? You've got this predicting y using constant plus coefficient times x plus some error. Great. Super simple, linear model. You can estimate it using linear regression. But let's say that x is a price. Well, let's say that your model depends on the value of something and not the momentary price, which is actually true of a lot of trading strategies. You want to be estimating the value of something, not the exact current price, because once you've estimated the value, you can compare it to the price and you can say, this is not worth as much as the current price, I should sell it, or this is worth more than the current price, I should buy it, right? And that's kind of the center of arbitrage pricing theory. And but the problem here is that because x is a price, it has random fluctuations around the value because markets are noisy. So what's actually going on here is that you have some error contained inside x as well. And this error is going to be dependent on the size of the coefficient. So your model is just going to be kind of weirdly misspecified in this case. And you'd have to modify the model to be this, to include the fact that the coefficient is being multiplied by this error plus this constant error term. So basically you're going to not be estimating the correct amount of error, and the type of error that you experience will be weird. The ways you can avoid this is, again, testing for normality, heteroscedasticity, and autocorrelation in your residuals. If you run those three checks against your residuals, those will pick up weird model misspecifications like this. Incorrect functional form is another one. This is just easy. Let's say, like, remember in Anscombe's quartet, if you have a quadratic data generating process, but you're trying to model it with a linear regression, that's just an incorrect functional form. You have hypothesized that it's linear. It is not linear. You're not going to have a fun time. Again, normality testing your residuals, heteroscedasticity testing your residuals, and autocorrelation testing your residuals will catch those issues. Okay, they're good smoke alarms. Put them up and just do them repeatedly. Here's another example, pooling different populations. This is easy, okay? You've got two different populations. You got your data set. Unbeknownst to you, your data set contains two separate populations. You model it using one model. That model is just going to miss and never predict either well, okay? So this is actually a fairly common problem in like large-scale studies where they'll try to like find a big overarching trend, but they won't correct for like weird things that are going on in the data. Like they won't factor out things. An example, let's say that you're trying to determine something about wages. Unfortunately, it's unfortunately true today that men's wages and women's wages behave differently, right? So if you try to say something broadly about wages overall, you might be missing out on the fact that there's two populations in there that are behaving differently, and you're just not going to do a good job of predicting for either, right, if you try to average them both. So you want to be careful about that, and that's just an example. Again, this case, you'd have heteroscedastic residuals, so heteroscedasticity testing would catch this case. Okay, the normality testing might as well. So again, normality test residuals, heteroscedasticity test residuals, autocorrelation test residuals. Three very easy tests. There are more tests you can do, but those are just three that will kind of catch a lot of the common cases. Here's another example in that same vein, which is we're looking at the relationship between operating cash flow and free cash flow. And it looks like there's actually a good relationship between that. So we can use a company that has free cash flow as high to predict for operating cash flow also being high, and that we can use this maybe to make money in a model. But the important thing here is that we're looking at only companies with a market cap over 100 million, which is common. You will usually kind of, when you're doing fundamental data analysis, oftentimes you'll just look at companies that are big to make sure that they're liquid and you can trade them easily. But this model turns out to be spurious because you have not scaled your data by company size. And if you scale your data by company size, you can see that this model falls apart and the R squared reduces a lot. And the basically what was being picked up on here is the same as in the multicollinearity, is that the company size was a driving factor behind both free cash flow and operating cash flow. So fluctuations in those things were being driven by this masked third variable, company size. And when you corrected for company size, you can see the relationship between the two drop a ton, right? Now, maybe this relationship is still good enough for you to trade on. Maybe this is still fine and you want to use this in your model. I don't know. That totally depends on what you're doing. But the important point is you want to correct for those masked variables. You know, you're pooling populations in a way that you shouldn't, and you want to split it out into different size companies and make sure that there's no relationship between the size of the company and how good your model is. Finally, this is a really fun example that I like a lot, which is non-stationary time series. And this is just an example of a random walk, which is a very autocorrelated time series. This is the definition of autocorrelation. This is the value at time t is the value at time t minus 1 plus some random noise, right? So this is a very simple textbook random walk case. Here's how it looks if you generate 100 of them. Now the key, what we're going to do here is we're going to say, okay, let's look for significant relationships. So let's say I pick one of them, that's my data series, right? And I'm going to look for ones that are above an R squared of 0.8 with that random one I've picked. And it turns out there are 14, okay? None of these are related. They're just completely random walks. What's the issue here? The issue here is that you assumed something about your data, specifically that it was stationary. And if you want to look up what that means, there's some description in the notebook, and then there's also, you know, Wikipedia, Stack Exchange can help with that. But basically what you did is you assumed that it was a stationary series, and you tried to look for relationships within the data set, and you found a ton of them, but none of these relationships were meaningful because in reality the data set is non-stationary. And when you have a non-stationary data set, you're just going to screw up all these statistics, and they're not going to be telling you anything useful. As another even more extreme demonstration of this, well, let's say we go to the p-values, right? Because you trust your p-values because you're a good statistician. So let's just look at the ones where you do a test and you say, am I related with another walk? And you just accept the ones that have a p-value of less than 0.05, right? 0.05. Now, in this case, if you have 100 things, choosing a p-value of 0.05 means that 5% of the time you accept that you're going to get a false positive. Okay, so you should see 5 relationships being generated, but you actually see 82. Okay, so clearly something is very wrong. Clearly you haven't calibrated right. Your p-values are giving you complete garbage. And this is just an example of you've assumed something that's true, you've made a model, it's not true because you've been lazy and you haven't tested for the underlying conditions. So you can use a Dickey-Fuller test to test to see if your data follows this type of case, and a Dickey-Fuller test will basically raise an alarm in these type of cases. So that's another one you can add on to that suite if you want to. Just go read up on the Dickey-Fuller test, figure out when to use it. Honestly, the autocorrelation test will also catch this case. So my guess is that using normality, heteroscedasticity, and autocorrelation will cover most of your cases. I'm not sure if you also need to include a Dickey-Fuller test. But the general idea here is that just really be aware of any potential biases, violations of assumptions, that kind of stuff. And you know, anytime you think you might be vulnerable to something like that, just go ahead and throw tons of tests at it and just be very worried if any of the tests come up as positive. Okay, so what does stationary mean? So that's a good question. The long and short of it is I'm not going to go into exactly what it means in here, but you can think of a stationary series as it's stationary if it doesn't follow this equation, whether this equation of x sub t is equal to x sub t minus 1 plus e sub t, right? So that equation is known as a unit root, and this is just all like mathematical jargon. But the general idea is that a stationary series is driven by a data generating process that is stationary, and an autocorrelated process is not stationary, right? Because it moves around based on previous values. Kind of it's self-driven. So I don't want to get into the exact definition of stationary, because when we were making this notebook, we all sat down and tried to figure out exactly how to define stationary, and it turns out that every book defines it a little differently, and it's kind of like one of those weird things. What I would do is, stock prices are often not stationary in my experience, just based on how things behave, and so it's actually very dangerous to try to model them using like linear regression, or try to look for relationships using correlation. My recommendation in this case is, if you're worried about stationary, just do an autocorrelation test on the stock prices. And if your autocorrelation tests says, hey, if your autocorrelation test says, hey, there's going to be autocorrelation in this data set, just don't assume you can't model it using some of the techniques that you would otherwise have used. You know, you can't throw a linear regression line through it. It's not going to have a normal distribution. It's going to be spiky. As an example, the S&P 500, just if you assume that it was normal, you would have basically the max and minimum returns you could ever expect would be so much lower than what you actually see. So like, I think the record on the S&P 500 is like 10 or 12 standard deviations away from the mean. And like in a normal distribution, those are like once in a billion year events. And we've seen like several of them in the last like 50 years. So like this, clearly it's not a normal distribution. Clearly it's fat-tailed. Something else is going on here. And what you want to do is you want to test for normality, test for heteroscedasticity, and test for autocorrelation. And those tests will catch you most of the time. I'm sorry that I don't have a better example for stationarity. But if you're still curious, go ahead and throw a question up on the forum thread. And what I can do is I can try to get you like a formal answer. I just can't give you a good one on the spot right now. Okay, so let's see, that's the final notebook. And then the last thing I wanted to go over briefly was David Edwards' algorithm. I see here that Alan in the chat has the hand raise symbol, which I've never seen before. I don't know if this is something that I was not told to watch for this. I don't know what that means, but if you have a question, please ask it in the questions box, and I can answer it there. I'm not sure what to do with this hand raise symbol, but I do appreciate that you have done it. And I apologize for not catching it earlier. It looks like it's been up for an hour. So, oh, and also, oh, Mark also had his hand up, but I think he asked a question, so that's okay. Okay, so let me just pause again for a few seconds here to allow for editing, and then I'll show you guys the algorithm. Okay, cool. So again, I'm going to go over to the community and lecture. And the algorithm is posted on this one. And before I show you the algorithm, I'm just going to still go ahead and say real quick, so this like whole academic initiative of developing this curriculum is coming from us working with a ton of schools. So we're currently working with over 13 schools now, and they're basically what's going on is professors at those schools are using Quantopian to teach their classes. And so like the curriculum that you're getting is being co-developed with professors at top schools. So it's being vetted, and we're pretty sure that this is, you know, high quality curriculum. But in that vein, if any of you know schools or professors that might be interested in using us to teach, please do get in touch with me and let me know, because we'd love to help out. It's all free. We don't charge anything. All we're looking for is exposure. We really want to help professors teach more effectively. And if any of you think you might be interested or know someone who might be interested, I would greatly appreciate the lead. And then finally, we have a student-only competition, which is open only to students in classes that are using Quantopian to teach. And that is kind of a baby version of the main competition. It occurs twice a year, and you win $25,000 in an account to manage for 6 months, rather than the $100,000 you get from the main competition. Okay, so this algorithm that David had released, I think is cool. It's an expansion on the algorithm that he released last lecture. And what it does is it uses Kalman filters to smooth out the pricing of securities, and then compute a spread, and then do pairs trading, which is when the spread is larger than you'd expect, you bet that the spread is going to come down. They're going to get closer to each other. So you short the one that's high and you long the one that's low. And then vice versa, if the spread is low, you assume that it's going to get bigger. So you long the one that is currently on top and you short the one that's currently on the bottom, and you assume that they're going to go in those directions. And the nice thing is, because you're always long and short equally, these things tend to be real market neutral, and you can see that in the risk metrics. This algorithm has a beta of effectively 0 and a really low volatility, very low drawdown. If you could look at the performance curves here, it basically never loses money. It's just always chugging upwards. And the thing that's interesting is that it doesn't beat market returns, but that's actually totally fine. Okay, a big problem that people have is they chase market returns. The market does a ton of weird stuff. There's a ton of volatility in it. Now, if you want to be the best hedge fund in the world, get 12% per year no matter what, right? There's maybe 5 funds that can do that. And that's what Quantopian is aiming to do with this crowdsourced hedge fund, right? We want to be low beta, no volatility, no drawdown. We don't care what the market does. We're just going to deliver 12% per year, right? And the important thing is that, let's say that this algorithm, it looks like the annualized returns here are about 9%. That's totally fine, because once you've bet on something, once you're really confident in something like this that has the risk profile is so good, it's so low, your Sharpe ratio is the thing you should be trusting, because your Sharpe says that you're getting a lot of returns for the risk you're taking on. And what that means is that you could even leverage it out just a little bit to get it up to 12%, and then just have this thing that's giving you 12% returns per year that's just always going up, no matter what. This never goes down, it just chugs on upwards. And so how he does that, and I'm just going to go a very quick overview right now. And if you guys have questions, post them on the forum thread, and David will get back to you if you have any questions about how to build out certain parts of it, why he made these decisions. He's really good. He will definitely answer your questions on that. But the general idea is he makes these classes, this class of Kalman pair trade, and this Kalman pair trade takes in the pair that you want to trade and some parameters for how the trade should work, basically how the model should behave. And so what you can do is you can just initialize one of these Kalman pair trade classes for each of the pairs you want to trade. So you can just swap in and out your pairs here. You can change the model a little bit. Maybe you want to adjust the entry and exit points, so you move those to be parameters of the object, the class. I actually think that that's a good idea. And maybe we'll release another version of this algorithm with more of the parameters and the initialization method. But the general idea is that you can swap in and out whatever pairs you have researched and think would be good. And then the more pairs you're trading, the more consistent your algorithm is going to be. And I don't know, a rule of thumb, maybe you want to be doing 10 to 30 pairs. And then you have an algorithm that's, if one pair screws up, that's not going to screw up your entire life, right? It's 1 of 30, that's fine. But again, the general idea is that you have these classes, you initialize the classes, and then instead of handle data, now this trading logic function is the thing that's scheduled to be executed every day. This trading logic function, like I said, just uses a Kalman filter to smooth out the prices, gets the spread, computes the z-score of the spread, how far away it is from the mean based on the standard deviation of these spread observations, and then based on that z-score, enters into positions, longing the spread or shorting the spread. And then there's a few other kind of cleanup stuff that you have to do just in case weird things happen that David put in there. David started out as just somebody on the site who was using it to develop his own algorithms and trade his own money, and then became an intern here. So what I really like about his algorithms is that these things are not just academically good. These things take into account a ton of stuff that he's learned about actually trading money. And he actually runs very similar algorithms on his own money, and they do pretty well. But yeah, so you can see here, These are just classes to actually do the Kalman moving average and Kalman regression. I don't think he uses Kalman regression. He wanted to leave this code in here in case any of you wanted to use Kalman regression to compute, say, like a hedge ratio between your pairs. And if you're not sure what that is, post a question on the forums, and we will answer. But yeah, so this algorithm, I think it's a cool algorithm. It's a nice pairs trading algorithm. You guys should check it out. And then the other one that we recently saw released here was by Justin Lent. And let me see here. Yes. So this is the another algorithm that Justin released, which has some pretty cool stuff. So this focuses more on some statistical tests that you can do while you're pairs trading to try to those fire alarms that I was talking about to make sure that the conditions that you're looking for are still there. And so what we're going to think about, I'm going to think about a way that we could like combine these two algorithms into one really good algorithm. But I would definitely look at both and see two different approaches to pairs trading. From two different people who come from different backgrounds. And this one focuses more on the fire alarms of making sure that there's no regime change that's been happening. And then David's algorithm focuses more on some of the nitty-gritty of like how you enter and exit positions. So they both have valuable both have valuable things to learn. But that's basically all I wanted to say today. I don't have anything extra. I'm just going to double check the questions in case there are any more questions. It doesn't look like it. And I am also just at about time. So thank you guys for coming out. Again, I'm Delaney. I'm working on this academic outreach initiative, which is developing this curriculum and working with schools. And we will have in the near future one page hosting all of these lectures that we've developed. And the goal will be to actually have like a full curriculum that you guys can learn from. Again, if you're unclear on anything, please post a follow-up question on the forums, or if it's something private because maybe it's part of your strategy that you're developing, you can always email me directly. I'm Delaney at Quantopian, and if you're unsure how to spell that, you can just go to any of these Quantopian lecture posts on the forums, and my name will be on there. But again, thanks everybody for coming. I know it's August and this vacation month, so I appreciate your attendance, and I will talk to you later.